Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Monday, May 4th, 2020. And our top stories today: retirement savers stayed calm during market volatility in the first quarter, and the evolution of the QDIA. And joining me now to discuss this and a lot more, David Blanchett is the head of retirement research for Morningstar Investment Management, LLC. David, thanks so much for joining us on the program this morning.
Thanks for having me.
Well, it's great to see you. And I know Morningstar, in addition to doing investment management and managed accounts and a lot of investment research, you also do a lot of retirement research. And I know one topic that you recently highlighted was the velocity of money during this very challenging time in Q1. What's the research tell you?
Well, I mean, I think that it's safe to say that recent market volatility is unprecedented, right? We haven't really seen anything like this happen ever. And, we're curious, how are participants in 401k plans responding to what's going on? Are they making changes? And, high level, what we saw is in the last quarter, the movement in trading was about what we see on an annual basis. So it's 4 times the average movement in money, but it's very different across different investor types. I mean, high level, what we found is the participants who are in professionally managed solutions like managed accounts or target date funds were making a lot less changes than those who are self-directing their accounts or kind of trading without using a professional manager.
Yeah, and that's certainly not a recipe, in my opinion. I'm not going to put words in your mouth, but certainly self-directing can be challenging unless you are have the time to dedicate. David, you and I and the rest of the industry have talked about the growth of qualified default investment alternatives. So we have things like managed accounts, we have target date funds. Do you have a sense of how those did? I mean, it's a little early. We're in April. But do you have a sense of how those maybe performed relative to the average participant self-directing their account?
Yeah, I mean, to be honest, I'm not sure yet what the performance was of the various qualified default investment alternatives. I think that they're probably going to perform about as you'd expect on a risk-adjusted basis, right? Mm-hmm. So most of them are relatively risky, right? Most investors in defined contribution plans have, 20 or 30 years until retirement, and they've got retirement that's going to last 20 or 30 years beyond that. And so, they are pretty aggressive. I mean, the average participant lost maybe around 15% in the quarter. It could have been worse if it wasn't for cash flows. And so it wasn't a pretty quarter. And a lot of folks are going to be surprised when they see their statements. Now, they've made some of that back, since March 31st, but it was clearly not a good time to be investing. But I think like the key for me, at least for us, was that people that had help, that weren't doing it themselves, saw a better outcome in terms of less trading. So we don't know how things will go in the future, but the worst thing that we think that someone can do is be moving back and forth from cash and stocks and bonds and all that. So we want to get people to stay the course, and we saw some of that, but not among the folks, especially who are older. People closer to retirement were the ones that really made pretty profound changes in their portfolios, really reacted the most to the recent volatility.
And that's understandable. I mean, I think that particular segment of the population hit hard by the health aspects of this virus, but also hit hard if you're close to retirement. And David, we saw this back in 2008, where many people 4, 5, 6, 7 years away from retirement really had to push things out. Do you think there's some lessons that were learned from the 2008 experience and kind of ported over to this experience? I mean, did people learn those lessons? Did fund managers learn the lessons of 2008?
Well, I mean, I'd like to think so. There were a few target date funds that lost, there were the 2010 vintage that lost 40% in 2008, right? And so I think that what we see now is less of the kind of, exotic strategies, but at the same time, we had a very interesting market impact in 2008 versus today. So I don't know. I'd like to think that we're all smarter because of what happened, but I'm not convinced that we are. I think that the one thing that has changed, though, since '08 is that a lot of people are now using these default investments, right?
Yep.
We've seen more participants who are kind of, joining a plan and saying, hey, I don't want to do this. I'll just use a target event. And that, to me, will probably be the biggest thing. I think that people don't have to worry as much about trading and stuff like that. And so they're not, going to be trading at a time that they shouldn't be.
And really good point. In 2008, we had just had the passage of the Pension Protection Act in 2006. And that ultimately is what led to the growth of QDIA investments, to your point. That probably didn't really begin to really ramp up because you had auto enrollment, auto escalation, you had to default. A lot of consultants, investment advisors were working with employers to do that. So there is that difference, 10, 12 years later, most retirement plans, 401k plans are using a target date fund or a managed account or some other, or a balance fund as an example, as the QDIA, and they have adopted auto enrollment. So, I know the data's not in, but I feel kind of bullish on that people stayed the course.
So, I do too. The one problem, though, is that about 80% of participants who are younger use the default. Only about half of the participants who are near retirement do so. And so there's this interesting effect where people that appear to need it the most, like younger people actually that are suffering, are doing a phenomenal job. A lot of them stayed the course. A lot of them actually got more aggressive. And so we're seeing some, what I would call like really positive behaviors from younger investors. It's the older investors who are the least likely to use like the target date fund, but actually making the worst decisions. And so I think, to me, a really big important takeaway from all this is how do we get people who are closer to retirement to delegate investment responsibility, to use a target date fund, to use managed accounts, just to do something other than build a portfolio themselves.
And we've seen the growth, and I've got a couple minutes left, about 2 minutes left in this segment, but we've seen the growth of managed accounts, QDAs, but also robo-advisors. So it seems like more and more of the population is willing to trust and delegate. It's just a matter of, making these investment decisions. Unfortunately, fortunately, it's an individual's decision, right? Someone thinks that they haven't maybe learned the lessons, or maybe they did learn the lessons now, and that you really can't outperform the market as an individual. But you can when you partner with somebody who has the algorithms and the techniques and the ability to maybe do that on behalf of many clients.
Yeah, managed accounts is kind of the original robo. Managed accounts and DC plans have been around for over 20 years. And let's be honest. It wasn't widely available or scalable back in 2008, right? I think that, it's not perfect for everyone by any means, but, if I'm someone that wants a low cost, professionally managed portfolio, it's a pretty good option, right? And so I think that for me, the key is giving investors access to solutions that they're willing to use, that to kind of delegate that responsibility. And so I see robo as a viable path. I'm a big fan of financial advisors in general. I think that the key really is finding something that someone trusts enough to say, hey, I'm not going to do this myself. I'm going to let you handle this for me going forward.
Really interesting. Well, David, thanks so much for sharing the research. And we're going to go to a quick commercial break, and David will be right back. And when we come back, we're going to look at the possible evolution of these qualified default investment alternatives. You're going to want to stick around right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. They are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as one day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to David Blanchett, the head of retirement research for Morningstar Investment Management, LLC. David, thanks so much for sticking around with us this morning.
Sure.
And before we kind of jump into the evolution, I just want to check in. How are you and the team at Morningstar doing working remotely? I know you're in Kentucky. The team is dispersed around the country and in Chicago. How are you all doing?
So, I think we're doing great. I've actually always been remote for 8.5 years now at Morningstar, but everyone else is mostly in Chicago. And so, to be honest, it's kind of nice for me because everyone now has to kind of deal with what I'm used to dealing with. You got to do the Zoom calls and stuff. And so, but I've actually been really surprised about how everyone's been doing. One thing I have noticed, though, is that when people were in the office, work ended at 5 o'clock. Now, because people have kids and stuff, it stretches on just at all hours. And so it's been a great experience and things have gone, I think, as well as they could have so far.
That's great. Great to hear. All my best to staying safe and healthy during this tough time. So let's jump in here with the evolution of QDIAs. We had the CARES Act that went into place, and we've had several additional stimulus bills, whatever the right wording is. But we had this Secure Act that happened. It seems like a lifetime ago, David.
It does.
In December. But that really laid forth groundwork to really, in my mind, and I'm going to get your opinion on this and Morningstar's opinion, to improve a lot of these QDIAs. How are you all seeing the evolution of these investment instruments?
So, first I would say we're a huge fan of default investments. I think that if there's one thing we can all agree upon is that the average person is a terrible investor, right? If we go back to, 20 years ago when we had daily valuation and everyone all of a sudden had to build their own portfolios, that was just a terrible idea, right? We're America, we love choice. This idea, let's give everyone the chance to build their own portfolio. That is just not a great idea. And so, we've seen a huge evolution, right? Where if we go back 15 years, no one used default investments. Today, we've got a huge growth in target date funds. And so we just want people to hand over that responsibility, kind of whatever it is. And, I think that, the Pension Protection Act of 2006, kind of laid that foundation. With the Secure Act, it's kind of next generation stuff, right? It's more things along the lines of, pooled employer plans and annuities. And so I think, to me, what we're seeing is this desire to really help, 401k plans be a true retirement solution for participants, right? I think that for most folks, they view them as accumulation only. They're definitely evolving, though, to help people invest smarter and possibly even fund their own retirement. So huge strides. I love the momentum. A lot of good things happening.
Now, what about different asset classes? I know that talking to different target date managers, we had on Sue Walton from American Funds a couple of weeks ago. There have been some enhancements over the years since 2008 on the types of asset classes that create a little bit more diversity, things like tips. And I've even seen where stable value is something where stable value companies really centered on stable value are thinking about that. But are you seeing more diversification in terms of what you're looking at when you look at all these target date fund managers across the board?
Yeah, the answer is yes. And there's different reasons for that. The first kind of obvious point is if you're the 45th entrant into the TDF space, you've got to be different, right? And so,
yeah, you do.
You've got Vanguard and T. Rowe and Fidelity and American Funds that are really doing a phenomenal job. Then you throw in maybe BlackRock and some others, but everyone else is just this small piece of the pie, right? And so I think that, it's really kind of helped spur innovation. What excites me though more is what you see like in the custom space, where you have really everyone today does it, builds custom portfolios for a certain 401k plan, and that really lets you have innovative products you're not going to see in off-the-shelf solutions. And so I think that the future, really, in terms of innovative, targeted funds, is building, plan-specific portfolios using really any asset class you want. Right? When you get out of that 401k, the mutual fund off-the-shelf structure, you can really do almost anything. So I think that's where we're going to see a lot of really innovative stuff in the near future.
And to that point, you're hearing rumblings, or at least seeing the Securities and Exchange Commission change the definition potentially of an accredited investor.
Right.
In my mind, that means that things could open up for these custom portfolios to include things like alternatives like hedge funds and private equity. Is that your sense from talking to people in the field?
I think those investments have been trying to enter the 401k space for a long time. Right. And I think that's no surprise. I think there's just issues around daily valuation. It's kind of fees of fees. And so I think, like, to your point, what you need is you need really, really large 401k plans that are kind of using these strategies in their defined benefit plan and then kind of port them over into the 401k. And so, and again, like, that's why, like, I think those could emerge in 401k plans, but you see companies like I forget the name of the company in California. I want to say it wasn't IBM. It was maybe Hewlett Packard. One of them had Intel. I think it's Intel. A lot of hedge funds in their TDF, and so it was very expensive. And they're getting sued, right? And so I think that for better or for worse, there's a strong focus on cost inside of 401k solutions, and I get that. Like, you want participants to have low cost options, but at the same time, there are a lot of asset classes that can add value. Let's not utilize them just because they're more expensive.
Yeah, I think that's a really good point, David. The drawdown. We talked earlier about the Secure Act and annuities, but are there opportunities in this space for annuity-like products? Meaning, that word annuity. You talk to people, they love the guaranteed income. Right. It's still, with the general public and the lexicon of real Americans out there, it still has this negative connotation. Are there opportunities for investment instruments to help with the drawdown that are not annuity based? I can't even say it, but are there opportunities out there for not annuity providers?
Yeah, I think so. So I like to use the word personal pension. It has a much more warm fuzzies than annuity, because annuity, to your point, is kind of a loaded term. Yeah. I have mixed feelings about annuities and 401k plans. I think that almost every economist or academic would say that people need to annuitize more of their wealth, especially those in 401k plans that have higher balances. But they're tough, right? Like, they're often irrevocable. What if you've got health issues? And so I think what we need to see more of is just making them available inside the DC space and letting plan sponsors choose, right? I think that, for better or for worse, every plan is different. And, certain plans that maybe froze the defined benefit plan, they really want to make something available to the participants that provides the guaranteed income. And so, with Secure Act, we'll probably see more interest. And so I just want to see more plans really think about the option, because today, it's really only in between 5 and 10% of 401k plans. So if we can get that to say 25%, I think that's closer to where it should be.
And David, I want to wrap up. We've got about a minute and a half left. Managed accounts, what do they look like in your mind going forward, or in Morningstar's opinion going forward? How would they evolve?
Sure. So, managed accounts, again, there's lots of definitions within the DC space. I just call it's a robo solution for 401k plans. And I think that, two ways I could see a lot of adoption in the future. One is as part of what's called a dynamic default, where you've got the default investment for younger folks is, for example, a targeted fund, and then older people are, for example, invested in managed accounts. And that way you're kind of matching the personalization of the solution to who really needs it. Also, there's this new product called advisor managed accounts, where in the past, Morningstar or Edelman Financial Engines, we've built the portfolios. We're creating a new solution where a lot of really large advisors can build their own portfolios. And so we're, in that role, we're kind of more behind the scenes technology. But I think there's been a barrier to adoption where consultants and whomever else, they want to use their best ideas. This gives them the chance to do that. So if I had to kind of pick where it'll evolve in the future, dynamic defaults, advisor managed accounts, and then also just, more value. I mean, if you look at these services today, there's more and more going on, more to help participants accomplish retirement success.
Yeah, I can kind of see things like risk premia all being built in, and you have different, you have to basically fill out a little survey to figure out exactly where you fit in. You could have almost like 3 different types of managed account solutions within the same plan. Well, David, we're going to have to leave it there. Great to see you. Thanks so much for joining us this morning, and all the best to you and the Morningstar team during these difficult times.
You too. Thanks.
And that wraps up this episode of BRN AM. Have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.